this is question number 1 on practice homework 7 for module 11. So this is a typical forecasting problem. We're provided with a current balance sheet and a current income statement and current balance sheet. And we're also provided with a bunch of ratios, the ratio of many items on either the income statement or the balance sheet as a percent of sales, right? That's the assumption here. And if there's no such ratio provided, then the setup also says that some items won't change. So we can use that information as well. And then we need to pay attention to the rounding requirement. It says that round all your answers to the nearest whole number and do not use negative signs. And that applies to both income statement forecasting and balance sheet forecasting. And for the balance sheet forecasting, we also provided with the information of the capital expenditure and depreciation expense and long-term debt. And with that, we can do start our forecasting. So to do that, let me first copy the current two financial statements, the income statement and the balance sheet, to my Excel sheet. So let me use the paste special, and I want to use the text. And after that, I want to double check to see whether the numbers are actually without any issue. And it does seems to be the case, especially for the negative number. I want to pay particular attention to those numbers. So, and then I want to do the same for the balance sheet. Just copy the balance sheet to my Excel sheet. And also use the paste special and text. And also double check to see whether negative, especially the negative numbers are what I want, basically. And it does seems to be the case. And then I also want to copy the this table here, because this table says that what's the fraction of many items on the income statement to sales. So I want to paste the special and text. And so later on, I can just directly use this information in Excel. And then I want to do the same for the balance sheet, this table as well. So paste the special and text. So now I can start. This net product sales, net growth rate will be the current level times 1 plus this growth rate 15%. And net service sales will be the current level times 1 plus the net service growth of 40%. And then the sum will be their sum will be the total net sales. And I have basically changed the format of the sales to keep no decimal place to conform with this rounding requirement, round answers to the nearest whole number. And cost of sales will be a percent. So this percent will be relative to the total, if you notice here, total net sales. So this will be relative to this number and then times a fraction here. Just copy that 67%. But here I want to do a small trick. I want to fix this B7 because that's the number I will need for many other items on the income statement. So next item is fulfillment. This is still going to be a fraction of forecasted sales. So now I can pull the sale down until you can see that this reaches until the general and the administrative expense. And if you check that fulfillment will be $6, which is still the total net sales, and then times H7. H7 is this fraction here. And the same is true for the other items here. So that saves me some time. And then other operating expense net and there's no such information provided by this table. But if I go back and say whether there's any such information provided for the in the setup, and I can see that other operating expense net will be will have no change. So I'm still gonna use this same level as in 2015 for my 2016 level. And total operating expense will basically be a sum equals sum of cost of sales, all these expense items here, and starting from cost of sales and until other operating expense. So that's the total sales, and income from operations basically will be the difference between the total net sales and this total operating expense. And interest income here is assumed to be $60, and interest expense will be this level, will be 520. Yeah, 520. Again, I have followed the requirement. Do not use negative signs with either your income statement or the balance sheet. So I've been, even though the current, you can see that current number, this is negative, and this is also should be negative, but I have followed that requirement to only use the positive number. So that also means that when I actually do the calculation for example, this income before income taxes, I need to deduct this amount rather than adding this amount, because this is a negative number, this is the expense. So other income expense net here, there's no such information provided in the table. So let's go back to the setup and say other expense net is also assumed to have no change. So this is still be the same level as this level, but this is negative, so I want to use a positive number here, following the rounding requirement, requirement. So total non-operating expense, this will be this is the expense, so I need to separate the items here into expense and income. So the only income here is the interest income, but expense here we have two. So I want to sum up these two, interest expense and the other expense. This is also expense because this is expense. And then I need to subtract the income because here I'm trying to get the total expense. So income before income taxes now will be the difference between the income from operations, and then I subtract the non-operating expense. So that's going to be my income before income taxes. And then provision for income taxes will be based on this income before taxes, and then the tax rate will be 38%. And equity method investment activity. This is again based on the setup. There's no change. But again, because this is a negative number, but I cannot use negative numbers, so I need to put a positive number. But I need to remember this actually is a loss. So when I calculate the net income, I need to deduct this loss from the income. So I need to deduct both the income taxes and this loss, and so that's going to be my net income. So then we are almost done with the income statement, but we need to keep in mind that the reason we start from income statement when we do the financial forecasting is that we need some number from this statement to be brought into the balance sheet. And that number is basically one of the numbers is the addition to retained earnings, because when we get to the balance sheet, there's such item as for retained earnings. This is the cumulative amount. So next year, 2016's cumulative amount will be current year's cumulative retained earnings plus addition to retained earnings. So that's why we also need to get that information. But in order to get that information on the addition to retained earnings, we also need the dividend information. That's why I want to this dividend So let's check the dividend information, whether the setup provides any information about that. And that does say that the company pays no dividend. So that means the addition to retained earnings will be simply equal to net income. So later on, we have to add this amount to the current level of the retained earnings. That's gonna be my new retained earnings. So let me just do that. And then current level and retained earnings plus this addition to retained earnings, that's going to be my new retained earnings. Unless there's any other information, I don't think there's any other information stated about that. So we are done. Basically, we are done with the income statement. So now let's get to the balance sheet. The first item is the cash, but cash is what we call the plug variable, which means that it's used to balance the balance sheet later on when we have forecasted all other items on the balance sheet. So that means that we need to start from marketable securities, and there's no such information on the table. So let's go back to the setup and say that marketable securities, there's no change. So we still use the current level. And inventories, this will be this. So again, we use the same trick as we did here. So we because many other items on the balance sheet will be a fraction of this total net sales. Again, we want to fix this cell so we don't change later. So this is going to be the net forecasted sales and then times this fraction of inventory to sales. And then we just compare to say this matches. So let's pull the sales to the next item. This will automatically change to the accounts receivable, net, and other. And total current assets will be simply equal to the sum of cash, marketable securities, inventories, and accounts receivable. But since there's no cash, so we just need to we can just leave this blank for now. And property and equipment net, and this will be based on the net PPE. Basically, will be based on the current level of the PPE, and then we add the capital expenditure. That's the new purchase of the PPE, and then we need to subtract the depreciation over the 2016. So the capital expenditure of the for the 2016, we go back to the setup and we find that capital expenditure will be 4.3% of sales. So why don't I just want to be absolutely clear about what we are doing here. So let me add two more rows. First is the capital expenditure, and this will be 4.3% of sales. 4.3% of sales, and so this is going to be the total net sales. I don't want to fix this cell here because this information will just be useful for the capital expenditure here. And the depreciation expense for this year, right? Because the depreciation, the net here, PPE net here is the gross PPE minus cumulative depreciation. So in order to get next year's net PPE, we just need to get the next year's depreciation expense for that particular year only. And this is assumed, you can see that this is assumed to be 28.9% of the PPE balance at the start of the year. So that means we can just use the PPE balance. This is the PPE balance to 2838 PPE balance, and then times the 28.9%, and that's going to be my depreciation expense. So now net PPE for the next year will be the current year's net PPE, and then we add the capital expenditure, and then we subtract the depreciation expense for that particular year. So that's going to be my new PPE, net PPE level. And then goodwill. If we can go back to the setup and say goodwill will not change, so we still use the current level. And other assets, you can see that this will be the 3.20% of the forecasted sales. So we'll still use that total net sales and then times 3. Actually, let me just use the cell rather than typing it. So other assets here. So the total assets will be simply the sum of cash, basically sum of total current assets and all other items here. But the problem is that we don't know the cash, so we cannot right now calculate the total assets. So let's go to the liability section, and then accounts payable. Accounts payable, you can see that this is a fraction of sales again. So here I want to fix the net product sales, net total sales again, because the following 3 items will all be based on this net total sales. So times this accounts payable, and then I pull the sales down to until unearned revenue. And you can see the order here matches the order here, and that's what I want. So then the total current liabilities, I can just sum up these 3 items here: accounts payable, accrued expenses, and unearned revenue. So that's the total current liabilities. And long-term debt, again, this will be based on the current level of long-term debt, and then we need to find out how much of that current level will be repaid in the next year, 2016, and that's 238. So we subtract 238 from the current level. That's my new long-term debt. And the other long-term liabilities, will be assumed to be the forecasted sales, and then times the income, the other long-term liabilities. So that's going to be my new level. And then we go to the stockholders' equity section. And then let's go to the equity section. We can see that there are many assumptions made for the equity section. Actually, most of them are assumed not to change. So we can use that information. Preferred stock, no change, still going to be 0. And common stock, no change, still going to be 5. And treasury stock, no change. But here we need to be careful, because the setup says that we cannot use negative numbers, so we need to put just type that. And additional paid-in capital, there's no change. But we need to keep in mind this is a treasury stock. So when we get to the total shareholders' equity, we need to use subtract that amount. And accumulated other comprehensive income or loss, here also there's no change. But again, this is a loss, so we need to use a negative number of that. So retained earnings we have already calculated. So eventually we get to the total shareholders' equity, which is the sum of preferred stock, and then plus the common stock, and then minus the treasury stock, and then plus the additional paid-in capital, and then minus accumulated other comprehensive loss, and finally add retained earnings here. So that's the total. And total liabilities and shareholders' equity, we can calculate this number unlike the total assets, because we have all the items forecasted. So this is going to be the sum of total current liabilities and long-term debt, and other long-term liabilities, and then the total shareholders' equity. That's the total. And from this total, now we can back up our plug variable, which is cash. Right? The cash, again, that will be cash will be the difference because we know that the total assets here will also, because we know the total liabilities and owner's equity, we can also use that information and put that to the total assets. So now the total assets is provided, right? And the long-term assets we can also calculate, which is the sum of the net PPE and goodwill, other assets here. So then from that, we can figure out the total current asset, because the total current assets plus the total long-term assets, that will equal to the total assets. And total assets here is provided, so we can back up to figure out what's the total current assets. So total current assets will be the total assets minus this net PPE, and then minus this goodwill, and then minus this other assets. So that's the total current assets. And then from the total current assets, we can now back up this current cash and the cash equivalent. This will be simply equal to the total current assets, and then minus the marketable securities, and then minus the inventories, and then minus the accounts receivable. So that is my cash, and that's the final item. So now I can simply copy the number, all the numbers to the blanks. So the rest of the job is simply to copy the number back to the right place. So we start from the income statement. So this is the net product sales, and then we go to net service sales, and we just continue this. So I'm done with copying the income statement, and then I'm going to copy the balance sheet as well. And cash and marketable securities. So this is there is a total liabilities item which I didn't calculate in my Excel sheet, so I'm just gonna add that. And this is simply the sum of the total current liabilities and long-term debt and other long-term liabilities. So I'll copy this number back here. Alright, so I'm done with covering all these numbers to the two financial statements. So the next part B of this question is asking what does the forecasted adjustment to balance the accounting equation from part A. So that this basically refers to the cash, right? Because cash is used to balance the accounting equation. Reveal to us about the forecasted cash balance and related financing needs of the company. So this is basically asking about the level of this cash relative to the sales. How does that level compare with the what we call the normal level, which is based on maybe the current year's cash balance relative to the current year's sales. So if we do that calculation, the cash balance relative to sales, this is the cash. So I'm going to put it here, cash to sales. This is the forecasted level is this 22,727 divided by the total net sales here. So this is gonna be equals this one divided by this. So I'm gonna change the format to %, and then the 17.48. But the current level, let me put it here. The current level is gonna be cash is right here, and then I divide that by the current levels total net sales. So this is if I change the format to 2 decimal places, and you can see that 17.48 relative to 14.55 or 85. So this has increased. The cash balance has increased relative to the sales. So we just try to look for the answer which matches that observation. A, Amazon will generate sufficient cash for the coming year, and that's correct. The cash balance decreases fairly significantly. We could adjust marketable. That's not correct. The cash balance increases, right? And B, Amazon will generate sufficient cash for the coming year. The cash balance increases fairly significantly. We could adjust the marketable securities, leaving total assets unchanged. Yes, that's actually one option, because right now we do have, seems to be have the cash balance is above the normal level. So what we can do to lower that cash balance is to use a portion of that cash to buy more marketable securities. So this will lower that level. So this seems to be correct. And to make sure that the other answers are not correct, so let's continue to see whether the rest of the answers are correct or not. And C, Amazon will not generate sufficient cash. That's not correct, right? Because we saw that the cash balance has increased relative to sales. And D, Amazon will not generate. Yeah, okay. So this is this suggests that we have found this answer is correct. So now let me check my answer. And see whether we have got the right answer or not. So the income from operations, this is let's see, cash and cash equivalents. I guess this might be due to the rounding issues, so I'm gonna submit this and see whether that's the case. So finish attempt. This will give me the correct answer. So let's see whether we have got, yes, so it's $1 off. So this must be due to the rounding error, rounding issue. And this is also $1 off. And this is $1 off. So for that, if you have the same issue, I will surely adjust your points back. So this is also $1 off, and this is $2 off, and I guess this is because of the cumulative issue here. And this one is also $1 off, and this is $1 off. And finally, this is $1 off, and this is $1 off, and this is also $1 off. So all the incorrect marks are actually due to the rounding issues, which I believe I have followed this rounding requirement. So I don't know why the MBC had such an answer and will only accept such a just the individual answer. So I will take this as the correct answer. Let me stop here.